All right, so today I'm just going to go over some trading opportunities that presented themselves today, and using the both the wave chart as well as the tape reading chart. And I mean, for levels, I'm just using Renko, but you can use multi-hour chart like a 3-hour chart, 4-hour chart. You don't need to use what I'm using. I'm using Renko, but you can use 4-hour or whatever it is that you use just to see perspective in terms of a higher time frame. So that's what you can do. And then for the middle and the right, that you really need to have a wave chart and the tape reading chart. The wave chart, I mean, every platform has a zigzag with with the some swing volume or that type of indicator, Weiss wave, or whatever. So you can use anything that has zigzag indicator with labels, and those labels should have either time, price, or volume. You could use time and price too. In fact, that is how Wyckoff used it, because he's already looking at the volume on the tape reading chart, right? So you have the volume already over here. So you use time and price on the wave chart. All right, and so for regarding technology, just any paid platform should have a zigzag indicator with a Weiss wave or other labels. So Sierra chart. I mean, I don't really mention any of them, but I mean, any of the paid platforms should have this. And any paid platform with a footprint chart, you can just use this. So it's just a footprint chart. That's all it is. I've just put a footprint chart on point and figure. There's no rocket science. So footprint chart on point and figure is your tape reading chart. And any paid platform should have that. Any competent paid platform should have that feature. There's no reason why. Actually, the freer platforms won't have it. I don't think they'll have it. But the paid platforms, they should have it. And the majority of them, I'd be surprised if they didn't. Okay, so where was I? All right, so we just take a look at the trading opportunities. The first one I really want to mention here, right, is really important, because this is how accumulation occurs and then goes crazy. Right? So what you see here is a rally where it says RLY, rally. So when there is a rally, as a trader, what are you going to do? You're going to buy the pullback. Not that much more to say. You got a rally, you buy pullbacks. Right? You need two things. You need a rally, you need trend. So, the rallies with the trend, and now you buy pullbacks. So, you see the rally right here. I mean, it's so straightforward that you could even have an indicator that says rally. Right? It's not that hard to build out an indicator that says rally, or just look at it. It makes higher highs, clears the area, goes up, and you have a higher moving average. So that's your rally. All right, now you want to buy the pullback. So pullback, again, they only go to two places they generally go to. If you have a lot of follow through above the high of the prior high, then they'll test. What will they test? They'll test the breakout. Otherwise, they'll go in deeper into the origin of the rally, where the buyers will attempt to defend again. So again, pullbacks typically go to two spots. The first is the test of the breakout, and the other is the quote-unquote demand zone. That that's what it's called. It's called a lot of things, but it's just the origin of the rally, near the low. All right. So you have a rally. What do you want to do? We want to buy pullbacks. Where is it going to go? It's going to test the breakout, or it's going to go lower. When does it test the breakout? More often than not, is when there's a lot of follow through. Then it tests the breakout and then reverses to try to make a higher high. If there's not a lot of follow through above the prior high, then there's a deeper pullback near the origin of the rally. Okay, so you're just gonna do that. Where was this? Right here. Okay. All right. So the market is moving down, 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 down. Finally, here you see the white lines. It basically is in that zone or that level, right? And it gets oversold. Typically, that's the situation. That markets, two things happen. When you, on the left-hand side of the reversal, you have either some type of climactic oversold action, or you have shortening of the thrust. That's what happens. All right, so it goes to the zone or that level. So this is the area I'm looking at, right? That's this white line above this brick and on the low is the same as this white line up here and down there. So that's why I'm looking for the reversal. All right, now the key is as the market pulls back, right, and all this shit happens on the 5-minute chart, where it looks like it's all crazy, right? All it's doing is going to that level. Now you have to understand that when it pulls back, what are you looking for? Yes, on the left-hand side there should be either climax, oversold, or shortening of thrust. Yes, yes, yes. And then on the right-hand side you should have a change of behavior. We all know that, right? But on a tape reading chart, what should you have? Since it's a point and figure chart, it should clearly have accumulation, right? Accumulation and cause building, basically the base building. When I went into the study that I did, the first study, the tape reading chart study, if you haven't watched it, watch my prior video. What did you see in that chart that Wyckoff looked for? He looked for the base to be built, the change of behavior, the high volume prints, a line of support. Again, a line of support, right? And of course you have your springs and all of that, right? That look like breakdowns, right? So this is where you have it. You see this? This is your line. This is your line. This is the false breakout or the spring, which has the immediate reversal. How many times have we seen this in schematics and all of that, right? So this is where you have it. So this is what's happening on the base. On where is this happening? Okay, so remember, we're looking at the higher time frame or the Renko or the 4-hour, whatever it is that you're looking at. Market rallies, market pulls back. What happens on the pullback? Now we zoom into the lower time frames and the tape reading chart, and what do we observe? The base building right here. The fake breakout or the spring out or false breakout, right? So now that's it. It goes the other way. After it goes the other way, you can take the pullback long, because liquidity, all of the sweep and all of that has occurred. So what tells you that, yeah, it's going to go higher? The amount of buying. This is the biggest in the last 19 up columns right here. As the attempt went to break the low, the fake out, right? All of this buying came in and took the market back in and above the range. This is the range, right? This is the range, low to high. Just draw it like that. That's the range. That was the low. That was the high. Okay. All of this is occurring on the pullback to the demand zone. The demand zone, and whole thing happens here. the base building. Very, very important behavior. You got your base built, you got your liquidity grab or the spring, and then you have a breakout to the other side with heavy volume right here, telling you that that's where it's going to pull back and test. Because you know high volume areas are tested, especially in the ES. And then the index, that's why the break and test and all of that, they work. So on the pullback on a higher time frame or brick size chart, you have this rally from the base. As long as you have a base, you have support. Okay, the base has lines of support. And you need that because that is like, it's hard to go through. It's like, it's just hard to go through bases because there's so much volume there and you have a lot of stuck shorts and all of that. So anyway, so that's when this 79 here is the highest print, is a very high print. You had some buying here too, right here, the 112, all accumulation. But here it becomes very, very obvious. Sweep, breakout. Gotta get it on the pullback. You get on the pullback and you ride it up. It's a very easy trade too. Two bricks to two bricks, maybe 2 or 3 bricks to make 1, 2, 3, 4, 5, 6, 7, 8, 9. This is basically a 3 or 4 to 1 easy trade. Okay. So now I'm going to mention something about the tape reading chart. Now this chart, tape reading or whatever footprint chart, this is the missing link. You must have this type of chart, in my opinion, and I'll show you why. It's going to lower your losses a lot. All right, I'll tell you why. All right, so I was looking at this and I was going to establish a position on this breakout pullback, right? So you see this breakout right here? Right, breakout. Okay, now you have a breakout, it's going up. What are you going to do? You're going to get in, you're going to buy the pullback. But now notice one really important thing. If I was to tell you that when you have a rally, right? You have a rally and a pullback. Where should the biggest volumes be? Where should the big volumes be? In this simple structure or rail schematic here of a basic rally and pullback, where should the biggest volumes be? You would say within the rally, especially mid to low. All right, it should, because the CM would buy low to accumulate, and then mid to break out of a prior high, right? So where should it not be? It should not be at the high of the rally, because that means they're selling. So the bigger volume should be near the low, buy low, sell high, near the low, mid to low, not at the high of the rally. The big volume prints should not be at the high of the rally, and definitely not on the reversal. If they are, that means they become resistance, and also means that they're selling high. All right, they're selling high at the best prices. So I'm looking at this. This a breakout. You will see on where this is. You see here, everyone's having FOMO. Right here, they goes. They're ready to buy. They want to buy here at this quote unquote zone or that zone or whatever, right? What they don't see is what happened up here at the high. You will not see that on a wave chart. You will not see that on any chart unless you have some type of tape reading, footprint, DOM, or something like that. And the thing I noticed immediately was that in the low to the mid of the rally, you don't have such a high print, but at the high of the rally, the print is more than twice as big as any print from the low to the middle all the way up. So this is distribution. Now what does that mean? It means for you, do not buy the fucking pullback. That's what it means. Alright? Because this is a distribution, it means the pullbacks are not going to hold. The chances of the pullbacks holding are very limited because sell positions have been established. They've been established right here. And after that, this happens. What is this? It's a break of the low and high volume, because that's what happens on breakdowns and breakouts. They have high volume. So now it's set up the pullback to go short. So we know that these are high volume breaks and these are continuation trades, and what we want to do is execute the entry short. All right, meaning you have distribution in the background, you have the breakdown right here, you have the high volume prints. You know that they're basically clearing the way to go lower. They're clearing the way to go lower. And I know that this is not ending action. Why? Because it's high volume, not ending action, because it's breaking the low. You need high volume to break the low. So now it's just a matter of establishing the short position, and these guys here established it. Now this is very significant because at the top, 83,000 contracts were sold. Someone or groups of people sold 83,000 right at the top. Someone knew something. They sung 83,000 contracts. Not a coincidence. And after that, the market breaks. Not a coincidence. 83 right at the top of the high, and then the market breaks. You see? So right here, what happened to break the low? 60,000 contracts to break that low, which is the highest print since the 83. So 60,000, the highest print since the 83, and before that there was 46,000. So we're talking about in this range here, 106,000 contracts. That basically is saying that we're going to break this low. It does not stand a chance. 106,000 break that low. All right, now we have a shit rally over here to here, and then you have the upthrust, which gives you the short sale. You can sell the short as it comes up, right? And then the market goes lower, 30,000 established, ding, 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 30,000, and go 38,000, start going sideways. There's some hesitation here. So this is where, you gotta just chill out and say, okay, it's not going anymore because it's basing out. So you really want to hold? Maybe it's going to go lower to another breakout level right here, 4228, which I think it has a shot at. Also, there's a lot of end of day accumulation, but I don't really count this because it's towards the end of the day and covering and all of that. I don't really understand how to use this because of the end of day. Folks are just covering. Anyway, so long story short, we are back at where? The demand zone. So don't you think that it's better if it's going to the demand zone that we were at before, from where the prior rally began, and it's going sideways? Might be a good idea to say, you know what? Have a good day. Bye. Right? So that's what's going on over here. All right, so what do we learn from this? We learned that when you have, well, first of all, we learned that there are a couple of lessons. when the market goes to a higher time frame zone or level, you have to have a cause. A cause will develop. It will take time, but a cause will develop. Let it develop. Don't worry about it. All right. Second is, when that cause develops, it can take a lot of time and go sideways, 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 and give you a false move, the spring, and then go the other way, which is fine. And you have to anticipate that in advance, right? Just know that when it goes the other way, it has to break. And by the way, where would Wyckoff buy this? He would actually buy the breakout above this area. See this area right here? That's the 10. He has no problems buying above there, like on the breakout. So as you saw from the last study, he's actually waiting for that higher high. After this market goes down, there's some base building, establishes the high, goes sideways. He's going to look for the dips and see how much are they dipping. Oh, 6, 1, 5, 4, 3. Aha. It's not really that much. Right? So if you notice the 1 and the 5, and you see the volume is just depleting, and then you have this selling, and then it reverses up and it takes out the high. So he's ready to buy up here with a stop below the low, or 2 bricks, or 2 boxes, or 2 boxes below the low. And where do you want to buy? Where do I want to buy? I'm going to buy the pullback. I know where it's likely to pull back to. Where it's likely to pull back to, the 79 or right above it. How do I know? Because this is where they're defending. Remember, what is support? Support is high volume with follow through. Then that high volume is likely going to become support. Why? Because when high volume has follow through, you have more buyers that will come back to those levels, and you also have stuck shorts. They took the opposite side that are underwater, and they want to get out at break even, and that will create the bounce or the continuation of the move after the pullback tests that level. Anyway, so that's one important thing. The second important thing is, when you have a rally and the top of the rally has more volume than the lower and the mid area where you would like to buy a pullback, that is distribution. That is climactic action. That right there is distribution or climactic action, and initiates the selling. What happens? Break right here. What happens after that break? First of all, the break is legit. 60,000, 46,000. Very nice break. Sell the pullback. Where will it pull back to? We know it's going to pull back into this area of 60 and 46. It might go a little deeper. Why will it go? Just keep testing this area. So establishing the short, and then it just keeps on going and comes back to the zone, and where the initial demand level or zone where you want to see if it starts base building again. There's no point to remain in the trade, because it's at that key buying level, right? So those are the important points. Is there anything else? Not really. So I guess I'll just go over what are some potential things that can happen. So since this is base building at that same level, there is a possibility that this retest might do another spring and do the same thing that you saw here, like the same thing here. There is very likely possibility the same thing's going to happen here. Okay, that's very likely. All right, that's one if they hold this level. Otherwise, if they break it, it might go deeper in the zone, or if it starts trending, it can go all the way down to the POC area, which is 4228. Why? There's high volume there. What does that high volume mean? It means, again, that they're stuck shorts that will want to get out of their position at break even, along with new buyers coming in, and you have a shot there for a reversal trade. Okay, if it breaks and it starts continuing down, going to that area, it's going to offer more continuation, meaning break and test trades to the downside all the way to that area. Alright, so we're done with this. And alright, so yeah, basically I'm looking at 4228. I think it might break down and take that out. It's likely, but we'll see. Alright, so I'm looking at that, and I'm looking at this area here to see if there's buyers that step in. If they step in, it'll be so overt that the volume here will peak up and all of that. So that's all there is. All right, I think that's all I'll cover today. I'll get back in the studies later on, and that's all, folks. Thanks. Bye.